Welcome to our explainer. Today, we're going to dive into something that might be quietly changing the game for your retirement savings. We're talking about a whole new wave of investments that are popping up in places you really wouldn't expect.
So, have you ever logged into your 401k account, scrolled down and seen terms like private equity or private credit and just thought, what in the world is that? Well, if you have, you're definitely not alone. And no, it's not a mistake. It's actually a sign of a really big shift that's happening in the investing world right now. And just how big is this shift? Well, get this. According to a recent survey from BlackRock, nearly 1 in 4 retirement plan managers are seriously considering adding these exact types of assets. So yeah, this isn't some niche trend anymore. It's going mainstream, and it's happening fast.
So, all this popularity brings us to the big question, right? What exactly are these so-called alternatives? And why, after decades of just sticking to plain old stocks and bonds, are they suddenly everywhere? At its core, the definition is actually pretty simple. Just think of it like this. An alternative investment is basically anything that isn't a traditional stock, a bond, or cash. And that simple definition opens up a whole universe of possibilities. We're talking everything from real estate and private companies to commodities and even collectibles like fine art. I love this quote from our source material because it nails what's going on here. Calling these investments alternative today is kind of like calling a band like Nirvana alternative. I mean, sure, they were once, but just like grunge rock went from tiny underground clubs to dominating the radio, these assets are moving from the fringes right into the center of the financial world. So, what's the deal with the sudden surge? Well, it really boils down to two main things. First, a lot of experts are getting pretty cautious about future stock market returns. For instance, Goldman Sachs predicted that the S&P 500 might only deliver about 3% in annual gains over the next decade. And second, in today's choppy markets, investors are just desperately looking for new ways to diversify and protect their money. And this right here is the central trade-off. It's the big dilemma. On the one hand, you've got all these amazing pros: diversification, the potential for really high returns, access to new markets. But on the other hand, you're dealing with things that are way more complex, definitely riskier, and often illiquid, which is just a fancy way of saying they're hard to sell quickly. Oh, and they usually come with much higher fees. This is the key puzzle we all need to get a handle on. Okay, so let's go on a quick tour and meet the main players in this new landscape. Think of this as a quick meet and greet with the most common alternatives you're likely to see, because each one has its own special role to play. And just so we're clear, this is not some small corner of the market we're talking about. The global market for these alternatives is already worth a massive $18.9 trillion, and it's projected to pretty much double by 2032. This isn't just a fad, it's a fundamental change in how people invest. So, what kind of things fall under this giant umbrella? Well, the big ones you'll probably see in retirement plans are private equity, real estate, and private credit. But honestly, the world of alternatives is huge. It includes everything from hedge funds and commodities like gold to even more out there assets like crypto and collectibles. All right, let's kick things off with private equity. This is where funds invest directly in companies that aren't traded on the stock market. The goal here is huge growth, but you gotta know, it's a marathon, not a sprint. It tends to follow what they call a J-curve, which means you often see losses at the beginning before, hopefully, the really big returns start to kick in down the road. Next up, we've got real estate, a true classic. It's always been seen as a fantastic way to hedge against inflation, right? Because when prices go up, property values and rents tend to go up too. And it's been pretty reliable, delivering stable annualized returns of around 7% over the last decade, often with a lot less drama than the stock market. And then there's private credit, which has become a massive player in this space. Basically, these are funds that act like a bank, lending money directly to businesses. It's become a huge asset class that can generate a really steady stream of income. And here's the cool part. Since the loans often have floating interest rates, they can actually do better when interest rates are on the rise. So for the longest time, these kinds of investments were basically off limits unless you were a giant institution or super wealthy. But all of that is changing. So now let's talk about how regular investors like you and me can actually get in on the action. This table breaks down the main ways to get involved. So for real estate, you've got things called REITs, which are kind of like mutual funds for properties, and they're required to pay out 90% of their income as dividends, which is great if you're looking for income. For private credit, you have BDCs, which lend to smaller businesses and can offer some really juicy yields. And then you have newer options like ETFs that try to copy alternative strategies, and these things called interval funds, which are specifically designed for those hard-to-sell assets. Okay, let's zoom back out for a second. We've talked about what these things are and how you can invest. Now, it's time to get to the real heart of it, the big trade-off you absolutely have to consider.
And this chart gives us a fantastic snapshot of how the pros are playing this game. Look at this. Big institutions have about a quarter of their money in alternatives. Wealthy individuals are sitting at around 20%. But everyday retail investors, we're only at about 10%. That shows you there's a pretty big gap that's probably going to shrink as these things become easier to access. So, what's the bottom line here? Think of alternatives as powerful new tools in your investment toolbox. They offer a fantastic way to diversify your portfolio beyond just stocks and bonds. But, and this is a big but, they are not a magic bullet. They bring a whole new level of complexity, new risks, and new costs that you really need to be aware of.
And that brings us to a really key piece of wisdom. It's probably best to view these alternatives not as the main event, but more like a really important supporting actor in your portfolio. They're a powerful tool for boosting your diversification, not the entire strategy itself. And that leaves us with one final thought. As these once exclusive investments become totally mainstream, the very definition of a diversified portfolio is changing. So the real question you have to ask yourself is my retirement plan ready for that change?